Hey everybody, Paul Moore here. We are going live at BiggerPockets Live, YouTube Live, and Facebook Live. Great to see you. I was talking with no audio, but now I hopefully can be heard. So Whitney Sewell, Michael Wilcox, how are you? Justin Hilton, David Sevilla, tell me if you can hear me now. So excited to talk to you today about why multifamily investors are turning to self-storage. Hey, Whitney, thanks. All right, thanks. Thank you, Zach. Okay, Armand, David, welcome. Where y'all from? Would love to hear where you're from. Hey, Nick White. Hey, Peter Schuler. Let me know where you're from. And please share this video. We would love to be able to get in front of more people. And BiggerPockets would love it if you would share this video, give us a thumbs up, give us a smile, give us a heart, give us a like. And we're going to be talking today about why a lot of apartment investors, including my company, are turning to self-storage to get opportunities that we're having a hard time finding in the multifamily world right now. So, hey, Forrest, good to see you. Hey, Kelly from San Antonio. Hey, So Peter, I don't know how to say your last name. Skylar, maybe, from Telluride. Heard that's a beautiful area. Hey, Michael from Pennsylvania. All right, Ohan from Las Vegas. Tim Paulino, hello. Tommy Ricks, Katharina, Betsy from South Lake, Texas. One of my business partners is in South Lake, right downtown. Beautiful area. Wyatt from Grand Rapids. Hey, Gurvinder from Seattle. Carlos, Hector, Corderell. Thank you so much for joining. We're going to talk today about why multifamily investors in some cases are turning to self-storage. So we're going to get started in just a second. Just give me an idea. What are you folks finding? Is anybody finding great deals in multifamily right now? Tell me if you're looking for, duplexes, fourplexes, 800plex, if that's a word. What are you finding right now? Would love to hear. Is it hard? Is it hard out there for you as it has been for us? I know Whitney Sewell's right here in my town. I know he's telling me it's difficult to find multifamily here in this area. But would love to hear from you on your experience. We're killing a few minutes here till we get started while a few more people join us. So again, please give us a like. Please give us share, thumbs up. This will help us get the word out to more people in the world who don't know about BiggerPockets, who are not attending these events. So David Sevilla says, no good deals anywhere. Hey, Doreen from Philadelphia. Ronkan, I'm not going to try to say. Hey, Robert Shearer from New York. Hey, David Isaacs from Yankton, South Dakota. I've been to South Dakota a number of times. It's a beautiful place. There's some beautiful stuff there. So Robert Haynes says, multifamily in my area has been a bit harder to find, especially where it's a bit harder to manage. I've found more luck placing multiple properties on a single parcel like manufactured homes. Hey, we should talk about manufactured homes today because I think it's another asset class that a lot of people are turning to when they can't find multifamily. The question I get asked a lot lately is multifamily in a bubble, or is this the new normal? What do you think? Is multifamily in a bubble? Is it about to crash? Is it like the other times, that everything heated up, overheated, and then crashed? Or is multifamily just kind of in the new normal? And Isaac says, I've been noticing a lot of new construction and rental units. Absolutely. Peter says, just invested in mobile home park in Florida. The numbers are better. I agree that they usually are these days. Looking at an 8-unit now, says multi-available limited value adds. Okay. A 3-family. By the way, I know you guys, but I'm actually older. I'm not a millennial. I don't know. Seriously, I chat items to stay on my screen in Facebook, and it's just something to do with going live. I can do it when I'm not live. So if you don't get a question and you're in Facebook, please cut and paste it. So I am a multifamily syndicator. Is anybody saying that it's a bubble? Yes. Wyatt says it seems like a bubble. Not going to pay $200,000 for a 2-unit, renting at $800 a unit. Yeah, smart. Hey, Mark. Mark Neff says he found one. Regan says duplexes in Midwest still has cash flow. So I have been a multifamily syndicator for some time. I did a ground-up multifamily development in North Dakota, kind of a. And when I got into Class B value-add multifamily, I was so excited. I knew I was going to be where I wanted to be for the rest of my life. And it was something I wanted to pass along to my kids. I did about, and I knew I could do for a long time. We got into it, and then the market went crazy. I mean, from 2000 up, and it's kind of leveled off the last couple of years. But the question is, for a multifamily property, why would they do that in the first place? Why would anybody overpay for anything? So I'm in my 50s, and I don't like overpaying for things anymore. I used to, and investing, I thought I was investing, but I was really speculating. You know, investing is when your principal is safe and you can hope for a return and expect a return. That's investing. But when your principal is not at all safe and you're hoping for a return, that little tweak is called speculating, and it could even be called gambling. And I was doing that for years. And it's okay to speculate. Totally okay. I talked to a developer in California today who's speculating. He's going to make a great return, but his principal is not completely safe. And so it's okay to speculate as long as you know you're doing that. When you think you're investing and you're actually gambling, that's when the problem comes up. So anyway, a lot of people do that, and I don't really want to do that anymore. So I asked myself fairly recently, why are people, for like $200,000 for a duplex that, cash flows $800 a month gross each side as someone? Well, there's a couple reasons. Number one, they might have 1031 exchange money and they'd rather overpay a little than pay Uncle Sam. And I understand. Another reason is they may have international investors from other countries, places like China, who say, if I could just get into a U.S. commercial investment, I would be happy, even if it's a break-even deal. That's pretty hard to compete with. And those folks are buying some of the properties that we're bidding on. We're buying, we're trying to buy 100+ unit apartment complexes, and it's tough to bid against them. Also, institutional investors are going to smaller and smaller markets, smaller and smaller assets, and to try to get value. Well, they're willing many times, like insurance companies, REITs, others, they're willing to take a very small stabilized return, and it's really hard to compete against somebody who's happy with a 4% return when our investors are looking for, let's say, 8%. So that's pretty tough. Another problem is operators who are ignoring the fact that it doesn't cash flow and they're counting on appreciation. Now, those of you who follow Rod Cleef and others know that that didn't work out very well for people in the last recession. They bought hoping that it was going to appreciate, and it didn't. Things depreciate sometimes, and things go belly up. And so a lot of people who are counting on appreciation, honestly, that's a form of speculation, and I would not do it. Now, it's one thing if you're flipping houses, and that's kind of more your business. But if you're buying and holding, and it has to appreciate to be able to afford it long term, that is a pretty dangerous strategy. Another problem is less experienced syndicators with access to funds are mistakenly overpaying. This multifamily boom has brought in tons of syndicators, new investors, new operators, and that's some of the people on this, on this BiggerPockets event right now. And that's okay, but sometimes they're overpaying, and sometimes we're all tempted to overpay. And it's not a good idea, but it's hard to compete with people who are doing that, people who have access to millions of dollars and are willing to pay too much. And then, I hate to say this, but there's probably some less than scrupulous operators out there who are willing to overpay just to get a deal, just to make the fees, just to own a property. And so it's really hard to compete with them. And so the question I asked earlier is still a question I want to, we don't have a definite answer for is this a bubble, or is this the new normal. And it might be the new normal. The problem is, if you can buy a property and it cash flows at, let's say, 5% net to the investors, and the syndicator owner is able to get a return as well. Well, that's actually more than people are making in some other countries. I've talked to people in China who are investing in other places. Like I said, I've talked to people in Japan, New Zealand, Australia, Europe, and they say that's actually a pretty good return, and their cap rates are more compressed. So what I'm saying is, it is a really, really difficult time to buy multifamily, and it might stay this way for a while. We don't know. It might be the new normal until the next economic shock, and we don't know when that'll be, of course. Or it may be that this is a bubble. Ben Colley's just joined us, and Ben doesn't think this is a bubble. I think he thinks it's a new normal. Ben is a multifamily expert. And so he convinced me a couple months ago that this is probably not a bubble. It's probably more like the new normal. So what are we doing? Well, it's kind of hard for a guy who wrote a book called The Perfect Investment, which is a book on multifamily investing, to admit that maybe it's not the perfect investment if I can't find any deals. And that's kind of where we're at right now. We kind of feel like, I love multifamily. I believe that if I lived the next 150 years, I'd still be doing multifamily 100 years from now. But self-storage at the moment seems to make more sense for a lot of people. So we're going to talk about some of the reasons. Number one, it's a very fragmented market, and there's a lot more deals available. Now, there are about 53,000 self-storage facilities in the U.S., which is about the same as the total of the Starbucks, McDonald's, and Subways combined in the U.S. So there's a lot of facilities out there that have popped up in the last 40 or 45 years. A whole lot of them, like 76%, are owned by independent operators, one-off deals, mom and pop operators, and they're not operating these things optimally most of the time. Okay, so I've kind of concluded, if you've thought about how hard it is to operate a self-storage facility versus multifamily that has all the hassles of toilets, tenants, and trash, I would tell you that most people would think, self-storage is a lot easier. There's so many reasons for that. But here's what I would say. Self-storage is easier to operate. It's easier to operate a mediocre facility, but it's actually quite complex and challenging and complicated to operate a fantastic self-storage facility. And this is where the opportunity is, my friends. There are thousands, and I would even say tens of thousands of self-storage facilities that are being operated just fine. They're humming along. They might be making their owners a 10 or even 12% return. And the owners, they may live in an apartment on the property, as I know one is, what I'm thinking of near Kansas City, or they may live next door, and the owners may just be really happy with what they're making. They may have paid it off and be making a 20% return per year. It's not that hard. But to operate it really, really well and to maximize it, to really raise the potential, there's a lot of complexity, including raising rents, adding all kinds of point of sale items like boxes, scissors, tapes, locks, charging late fees, charging admin fees, raising rent strategically at the right time of year. So there's all kinds of things that can be done to raise the rents, therefore the income, therefore the value of a self-storage facility. And that's where the opportunity is. It's very, very hard right now to find a multifamily asset where you can raise rents, where you can add value, where you can do all this stuff. But self-storage is much, much easier. So a lot of people are turning to self-storage, number one, because they can find deals when they can't with multifamily. Number two, financing. It's very similar to multifamily. People who can get finance for multifamily but can't find a deal can often get finance for self-storage, and they can find a deal. And so that's number two. Number three, even though you would think, when I think of value add, I think of adding, changing out the bathrooms, changing out the kitchens, adding carpet or hardwood floors. In self-storage, I'm scratching my head when I first heard about value add. How are you going to add value to a self-storage facility? Well, there actually are a lot of ways, and I mentioned a few of them a minute ago. You can add U-Haul, for example. Adding U-Haul to a self-storage facility can sometimes bring in $2,000 to $3,000 in additional income. Now that's, let's say, $30,000 a year in additional income. Divide that by a cap rate of 7%, and that is about a $450,000, almost a $500,000 increase in value to that facility. Now think about that. $500,000 of increase just by changing a policy or procedure, if you will. In other words, you don't have to build anything new. You don't have to add any facilities. You can just add U-Haul, okay? You can do something similar by increase value. Another way to increase income and value is through the fact that the tenants are more sticky. Rents are you can raise rents a lot more easily. So that's the fourth reason people are turning from multifamily to self-storage right now. Now think about it. If I have a $1,000 a month apartment building that I'm renting out, if I raise the rent 6%, my tenant might leave for that $60 a month. Number one, what's that, $720 a year. And number two, they know they're going to be living there for a very long time. Now, self-storage tenants are different. Think about it. If I raise the rent on a $100 self-storage facility by $6, well, are they really going to take a Saturday, rent a truck, get their friends, give them a 12-pack, putting together all this effort to load up this facility and move their stuff down the road? Probably not. And so the rents the rents are more price elastic, as they say in economics, and the tenants are more sticky and they're willing to stay around. And here's another thing about these tenants, okay? Often, and I know I was in this boat when I rented self-storage, they think they're only going to need it for a short time. They often think, I'm only going to need this for 3 more months. So for 6 times 3 is $18. I am not going to move down the road because they raised my rent by 6%. So I know there are operators out there who raise the rent on tenants 6% twice per year. I'm not kidding. So 12% a year. Now there's obviously significant limits to this kind of thinking, but you get a new tenant in with a move-in special, maybe 50% off the first month, a low rate on the beginning, and then it's hitting their credit card every month. And one investor that my friend talked to said, I decided to invest in self-storage when I thought about the fact that I've been paying for self-storage for 7 years, and it's been hitting my credit card all these 7 long years every month, and I completely forgot about it. And that's when they decided to invest, I should say, in self-storage. So there's a lot of increase in value you can get in the self-storage world. Another reason multifamily people are moving over to self-storage is that they did surprisingly well during the last recession. Now let's think about this. Multifamily did well during the last recession, in part because people were downsizing from homes. They might downsize from a house that they owned to a smaller house that they rent, or they might even downsize to an apartment. So when they did that, obviously, rentals did surprisingly well. In fact, if you look at graphs that I have in my book about multifamily, they will show you why and how multifamily did during the last recession. We all know that it did fairly well. Now, what about self-storage? Think about what I just said. If people are downsizing from their 4,000 square foot home to a 2,000 square foot rental home, or just a smaller home in general, or downsizing from any home to an apartment, they might consider going to self-storage. Think about it. Self-storage is a small percentage of their total monthly budget, even if they're underemployed or even if their rent it went down from, let's say, a mortgage of $3,000 a month to a rent of $900 a month, paying an extra $100 to keep those family heirlooms, or whatever their spouse might want to hold on to, is not willing to part with during this difficult time. For an extra $150 a month, they're often willing to do it. Like I said, self-storage tenants are more price elastic and more sticky. So these are some of the reasons that a lot of people are turning to self-storage, and it's a lot of the reasons that we, Wellings Capital, my company, was fairly reluctant at first to look at a different asset class, but we decided to. And so those are some of the reasons that people are turning from multifamily to self-storage to get double-digit returns. By the way, I didn't talk about double-digit returns. Now, returns in commercial real estate are made up of 4 components, and we can call them CAPT, which is CAPT, which is a lot better than CATP. Think about it. Okay, maybe you shouldn't. Anyway, CAPT. Okay, so C stands for capital appreciation. Okay, no, it doesn't. It stands for cash flow. CCC can stand for 2 different things. Okay, let's edit that out. C stands for cash flow. So the first way a return is made in multifamily and self-storage is through cash flow. And that's the monthly cash flow you get, the quarterly dividends as an investor, etc. Now, A stands for appreciation. That would be, the appreciation. And with leverage, that can be pretty significant. We recently, in a multifamily deal, we were able to add 10% to the bottom line, which was $65,000 a year. But the appreciation on that was driven by the fact we added 10% to our income. You'd think we added 10% to our appreciation, but that's not true at all. We added like 28% to the appreciation because of leverage. The debt on it allowed us to accelerate that appreciation. So that's an incredible benefit of all commercial real estate, especially multifamily and self-storage, which is what we're involved in. So it's CAPT, cash flow appreciation. P is principal pay down. I didn't even think that was part of the return at first, but of course it is. It's money that comes in and it's paid to the bank who holds it till a refinance or sale, and then that's distributed to the investors. So that P is principal pay down. The fourth is tax savings. T, that's not a quantifiable number that's the same for everybody. It's the incredible benefits, the incredible tax savings available to multifamily and self-storage investors they're kind of legendary. And so I've talked about that on other live events. You can go look those up. I've written about it extensively at BiggerPockets. There are about 13 different tax benefits that commercial real estate investors get that are, honestly, if the American people knew how little we're taxed, they'd probably have another tax revolt, but that's another story. Now, so we have got, Cat P. We have got the same situation in self-storage that we have in multifamily. Cap T is still in effect, and the leveraged acceleration you get in appreciation in particular is pretty stunning. If you can add 20% in income to a self-storage facility, which honestly, again, with all these mom and pops who are somewhat poorly operated, it's not that hard to add 20% in income. We also didn't even talk about all the ways to reduce costs. That's another thing. But you add 20% to the income, but this might actually add something like 50 or 60% to the appreciation, because the value is based on the income divided by the cap rate in commercial real estate. Therefore, if you are able to increase the income of the property, when you take leverage into account, it accelerates that income increase into a much higher appreciation. So if you can increase your value of your facility by 50 or 60%, then keep raising the rents, keep lowering costs, doing other things to increase the value, you've got an opportunity to basically double an investor's equity in several years. For perhaps, 5 years, doubling your money, that's 20% a year, double-digit returns, and then some. Now, one area I forgot to mention is a lot of these mom and pop operators have more land than they do buildings. In other words, they might have 6 acres, but they might only have buildings on like 2. And you can go in, if they're in a great location, and add more facilities. The land's already paid for. It's already zoned properly. And so the cost is simply the cost of the building. And we're talking about steel and rivets. Now, this might make you think, well, that means a lot of competitors could pop up around us as well. And I agree. That is certainly a risk to self-storage, and it's something that always needs to be accounted for. We looked at a property, an investment property in Marietta, Georgia recently. It was built in 76, I believe, and it was a sleepy little town. And this actually was Roswell, Georgia, and it was a sleepy little town when it was built. It was on a main road, but it wasn't that well populated. Well, now this place is booming, as you can imagine, just north of Atlanta. And so there's not a chance that I can think of where any competitor could come in and buy a piece of land on that main highly traveled road and compete with them, okay? So that is what I'm saying. If you bought that facility from, let's say, a small or independent operator, and you were able to build it out, add new facilities, which they're doing, the people that bought this are doing, it's a tremendous opportunity to add value and give investors 20, even 30% annual total returns. And that's the total return from all of the cap T. Now, see, I'm starting to say it. Okay. I'm going to take a quick break for a drink, and it's a great time for you to ask questions. So if you've got questions, you're on BiggerPockets Live. I'm going to try to get to every one of those questions. Everything on YouTube Live, I should be able to see. Everything on Facebook Live is going to be hard to see if I haven't answered it yet. So you might want to copy and paste your question back in. All right. So I'll start on Facebook. Matt Norden says, what book? I've got a book called The Perfect Investment, which is a book about multifamily investing. There's some great new books, by the way, coming out from BiggerPockets on multifamily investing. I'm not the author, but they're coming out, so watch for those. Jeremy Love says, what's the average cost for owning and operating a self-storage container? Now, if it's a container, Jeremy, I don't know. But the average cost to operate multifamily is in the 45 to 55% of gross revenue range. That's for multifamily. So the cost is basically half of the gross revenues. Self-storage, the average cost is only 34% to operate. So 66% goes to the bottom line in self-storage. And it's even better than that if you already have the land and you're building new facilities on that land. As I mentioned, the dollar cost averaging works really well. Thanks, Brian. Okay, I am running over here to look at YouTube. Dennis says, how about self-storage in California? There are 3 states I love self-storage in, and they would be Florida, Texas, and California. And one of the reasons is they don't have basements. Now, I know you guys are going to argue and say, well, yeah, this one has a basement or whatever, but there's very few. Texas only has less than 10% of the homes there with basements. I'm not sure why. It must be seismic or something to do with earthquakes, one or the other. That was a joke. Okay, seriously, but Florida, we all know that they have very few basements, if any, and it's so hot there they don't use their attics. So self-storage in Florida is great. Texas is great. California is great. Now places like the Midwest, like Ohio, where I'm from, and Wisconsin, Illinois, Indiana, they have a lot more basements. So they have less than the national average. The national average self-storage number, by the way, is 7 square feet per person in a 3 to 5 mile radius. So you can look for that, okay? Now, if you're in one of those Midwestern states, it might be less than 7. If you're in Florida, Texas, California, places like that, it may be more than 7 square feet per person. So there are software, there are programs online that'll help you analyze based on an address how many square feet of self-storage and how many people are in a 3 to 5 mile radius. So Sister Locks by Candy Sweets, hello. Where do you find self-storages for sale? There are commercial brokers in places like Atlanta, Charlotte, Raleigh. Those are areas in my part of the country that just deal in self-storage. Tommy Ricks, is this considered passive income? Yeah, if you're the operator, it's not. But if you're an investor, it is considered passive income. Michael, hey, Michael, where can you find these properties? Yeah, I mentioned that. Where else could you find them? Well, you can send letters to the owners. You can go visit the owners. There are lots of ways to find self-storage facilities. I have no financial gain from saying this, but there's a self-storage academy that a lot of people are going to learn to do this. And if you reach out to me on BiggerPockets, I will connect you to those guys. I don't have their information handy, but there's also about 5 books on Amazon on self-storage, and they're not all that up to date and everything. But anyway, you can look at that. Lloyd Almighty says, how can I learn more about this? Reach out to me on BiggerPockets. I'll try to tell you more, or you can look up the Self-Storage Academy. I think that you could Google that or look up some of the Amazon books on this topic. Habib says double digit meaning 5 figures. I guess what I'm thinking, Habib, there is, better returns. Okay. The cash on cash return from multifamily right now for a lot of people is pretty low. But the cash on cash return for multifamily, the return from operations is often over 10%. And then the total return, like I mentioned earlier, has been running for a lot of people over 20%. And that's annually, of course. Gamma Fighter says, what do you say to the claims that self-storage tenants are more sticky simply because they are more likely to eat food with their bare hands? This making them stickier. Man, thumbs up to that, Gamma Fighter. That's funny. I like that. I wish I would have thought of it. So what I mean by that is you can actually be licensed as a U-Haul provider. Have you noticed that U-Haul out there, they are actually in all kinds of self-storage facilities, not just their own. They're also in other They're also in other facilities that are owned by other operators. And so you can add U-Haul to your facility. Lucas Andrews over here on Facebook says, what are the best strategies for financing these deals? Hey, you can get owner financing from a lot of these. This is another benefit. 93% of apartments with over 50 units are owned by larger companies that own multiple properties, but 76% of self-storage are owned by individual operators with 1 or 2 facilities. So it's a pretty awesome opportunity here because of the fragmented market. You can also get financing through your local credit union, local bank. If it's a larger facility, Fannie Mae, Freddie Mac. And would you believe, speaking of U-Haul, parent company, which is a REIT, Real Estate Investment Trust, actually is a tremendous source of financing for self-storage. Glenn Miller says, lighting is optional, but you'll want it because you'll need to have outlets installed in the buildings to be able to run maintenance equipment. I agree. Elisa says, what type of conventional loans do you use and how do the loans differ from other real estate loans? Alyssa, I don't know if I have an answer. They don't differ that much. The interest rates are very similar. You can get non-recourse loans, which means you don't even have to sign on the loan and be personally liable if it's large enough. It's very similar to multifamily and other loans. Glenn Miller says, don't do U-Haul if you're going to do storage. It's too much hassle. Glenn, I've heard some people say that, and I've heard other people say it's not that much hassle at all. So the company that we're investing with right now, we're investing money with an operator that we really like. They say that the U-Haul is a great addition. I've heard a few people say it's a hassle. And so I like the idea of having it. I know an operator who actually has a storage van, a moving and storage van. They provide it free for people moving in to their facility. You can rent it for a day to move in. Isn't that a cool idea? I wonder if we could do both. Anyway, so Neelofer asked a few things. How do you compete with larger facilities? Great marketing, getting people out there, get in the community, get involved in the Rotary, etc. Rich Trot says self-storage financing through Live Oak Bank. Yes, Rich. I'm sorry. Rich, that's correct. I have heard that Live Oak Bank is one of the largest, if not the largest, private bank lender in the U.S. for this. Lloyd Almighty says, what is self-storage exactly? It's like a public storage. It's a place, a 10 by 10 unit or maybe a 20 by 20 unit where you can store stuff, cars, your eBay stuff, your grandma's stuff, when someone moves to a nursing home or unfortunately passes away. A lot of people store their stuff. If somebody's a college student, they might store their stuff for the summer. If somebody's on military assignment, they may store their stuff while they're over fighting for our country. So that's some examples. Startup costs for self-storage, David Sevilla says, I would say land plus about $35 to $45 per square foot will give you an opportunity to build a self-storage facility. I don't think I want to go anything deeper into something that I might misspeak on. Wyatt Smith says, buddy of mine is selling off some properties for way too much to naive young investors that run no numbers and just blindly buy. I assume you're talking about multifamily. However, it could be, you're talking about self-storage, right, as well. Glenn Miller says, also get involved in Self-Storage Association and also go to Vegas. They have conventions each year. I'm actually going to Vegas for a self-storage meeting in about 6 weeks, but it's not the big convention, although I do believe that you're right. Thomas Lynch says, appreciation is boring. Cash flow is where it's at. I agree. Cash flow's king. No doubt about it. Rich Trotman, not for the faint of heart. Instant equity of 25 to 35 stuff. Did you guys hear the podcast back in July? I'd say mid-July. And you can look for it, the guy in a coma who took a Kmart, an abandoned Kmart building. I think he had $7 or $8 million in it, and it's now worth $21 million. He converted it to self-storage. So if you're in Lynchburg or Roanoke, Virginia, and you want to do that, too late. Sorry. But if you want to do that in your area, look for an old, abandoned Food Lion or Kroger or Walmart, when they upgrade to the bigger facilities, and look for opportunities to convert those into self-storage. Sister Locks, do you purchase land and build a brand new facility? I don't, but I know people who do that. It's very profitable, as someone just said. Are you funding deals for us with Wellings Capital? We are willing to partner with experienced operators, but there's another way we can partner with people, and I wasn't going to talk about this today, but if you bring a deal, if you're out there beating the bushes and you find a multifamily or self-storage deal that fits all our criteria, we would include you on the ownership with that deal if you were the deal finder. And by the way, that is one of 7 great ways to get involved in the self-storage business or in the multifamily business. I've got an article out there, 7 paths. No, it's not. It's 5 paths to multifamily mastery or something like that. I've got a video on BiggerPockets about that as well, but it applies to self-storage too. There's actually 7 paths, but I only talked about 5 of them because I ran out of time or got bored or tired or something, or maybe I ran out of room. Justin Herrera says, I'm being silly, makes sense to invest in HCOL areas like North New Jersey and self-storage. Can you define HCOL? I'm sorry. Live shows, sometimes I don't catch every acronym. So, but yeah, I think that, places like that can be a good area because some of those areas have a lot of demand, not only from individual tenants, but from industrial, from small companies, people doing eBay, etc. So I'm probably going to be embarrassed. High cost of living. Thank you, Justin. It can make sense, but honestly, the competition in those high cost of living areas, HCOL, it can make it, difficult to compete for the properties as well. Sister Locks says, can we apply? Well, if you want to learn more about being a deal finder, contact us at my BiggerPockets profile, and we can tell you the different criteria we have to work with deal finders for self-storage or multifamily. So we are 41 minutes in to this presentation, and since I was on mute the first minute, I think it's only 40 minutes in, so we've got about 10 more minutes left. Thank you. More questions that you have. I'll take questions, comments, complaints, ridicule, whatever you want to send my way. I am ready for it. I'm tough, and I love to hear any comments that you have. And if you want to talk about anything else in the next 10 minutes, real estate related, whether it's multifamily, self-storage, or even something else, feel free to send in your questions. Building a biz. What's a good cash-on-cash return for self-storage? Well, now a cash-on-cash return from operations would be net to the investor, typically 8 to 12%. It's for me to dive any deeper than that and get into the debt and the split with the syndicator and all that would be way beyond the scope of this presentation. What's the name of my book again, Derek? Thanks for asking. It's called The Perfect Investment, and the subtitle is really long, like Achieve. I'm drawing a blank. Achieve multi-generational wealth from the historic shift to multifamily real estate. So it's available on Amazon. And so Don Spant says that's a great idea. What? Oh, Glenn Miller. Buy 7 acres, put a fence around it, and start pouring your first building pad. Start advertising RV, boat, car storage, then build your first metal building. Glenn, thumbs up. That's a great idea, and I agree that that is a good way to start. I've got a friend right now in Lynchburg. I'm trying to encourage him to level a house on the property that he is in control of and turning that into a self-storage facility. And I'm telling him to start by storage and then building up to a place where he can build his first building. So yes, thumbs up to that. Zero to hopefully hero. Do you think 2 self-storage facilities for a place like Martha's Vineyard, that was terrible, is enough, or is there still a lot of opportunity? So 0 to hopefully hero, I would recommend that you check out the self-storage square footage in a 3 to 5 mile radius, divide it by the number of residents in that 3 to 5 mile radius, add another factor in, and that would be, and I don't know how to do this, the summer population who are coming and going, who are not full-time residents, the vacationers, the vacation homes. Put in a factor for that and figure it out. I just looked at a deal in Key West, Florida in late July, and they had to add that factor of tourism in, and it actually helped because there were people who were vacationing there who used self-storage and they weren't full-time residents. So any trending change in cap rates on self-storage recently? Yeah, sadly for mobile home parks and self-storage, they're trending down, meaning they're being compressed, which means the prices are going up. By the way, another reason multifamily investors like self-storage is you can put together a bunch of medium to large size self-storage facilities, get them from where their mom and pop operated up to where they're really well run, and sell it at a lower cap rate, meaning a higher price, as a package to a real estate investment trust, to a REIT. I know a guy who he plans to sell, he projects a 7% return. This is the guy we're investing with. He expects a 7% cap rate, on the resale of a self-storage facility, but he's been actually getting a 5.2% cap rate. And when he sells these to REITs, and especially in a stabilized package, now that's a 26% bonus in the sale price right away. Now you think, oh, that's 26% extra appreciation to the owners if I did my math right. It's better than that. It's way better because a 26% additional appreciation in total means perhaps a 52 to 90% appreciation to the equity investor because of leverage. If you get a 75% LTV property where the bank basically is funding 3/4 of it, 2/3 to 3/4, it dramatically accelerates the appreciation. And I did that math off the top of my head. So if somebody's going to go calculate it, if they're on here right now, feel free to correct me if I did it wrong. But I think it's pretty close. Zero to hero, there are 15,000 residents wintertime and 300,000 in the summer. I had no idea it was that big. Well, check out how many self-storage facility, or at least the square footage of the facilities there. Figure that out. You can do the radius. Feel free to get hold of them if you want to talk about it. How much can you pick up a small self-storage facility for? I've seen 100 units for like $1 million. And I've seen them even less than that. Like I'm thinking of another one now. I know another one for about 150 units for about $1 million. So they don't. I don't think of it as by total picture. So I don't think of it by square footage or by the unit. Another number I've heard thrown around is $100 to $150 per square foot of really well operated self storage. I would question that because it depends on the income in that area. It could be much higher or lower. Glenn Miller. Look at the land near a school so that when development happens around it, you have instant customers. Great idea. I agree. Glenn, looks like you got some experience with this. Thank you so much for contributing. That's helping me today as well. No Had B says, excellent presentation. Thank you. Thanks for sharing this knowledge. Question though, how many units should one aim for in order for self-storage to be appropriate in terms of cash flow returns? That's a tough question. I'm going to give you a broad brush answer. Look for about 40,000 square feet, which should generate about 40 or 50,000 a month in gross income, which should generate about a $3,000 a month property management fee that you pay to someone who's charging 6%. You might have to rewind that, but my point is, if you get 50,000 in gross income, you're charged 6% in property management fee of about 3,000. That's about the smallest you'd want to be. Or you want to be able to get to that number. Maybe you buy a 20,000 square foot facility, but you can add on to it. I know a guy in Baltimore who's ripping off the roofs of the self-storage and he's going up one or two more floors. Isn't that surprising? But he's actually making a great investment because it's landlocked, it's in Baltimore, and it's able to go up. Rich Trott said enough to justify a manager. Exactly. My point. Exactly. Great. For 1 million self-storage facility, what's the down payment required, sir? Thank you. Kidding. I would say, $400,000 maybe down. So you assume you're you're borrowing 60%, but sometimes you can get the owner to finance that for several years. Michael Bloxham, do you send letters to owners? No, we don't, but yeah, you should. By the way, my son is flipping real estate. He's been writing handwritten, and I mean literally handwritten letter, envelope, crooked stamp, and he's been getting incredible results. It takes a long time. He pays his sister, who's 16, a lot of money to write a lot of letters, but it works. And so Building a Biz says, is that 10 to 12% for an investor? Or do you mean 10 to 12% cash on cash for the person company that buys the storage complex? I kind of didn't want to dial into that. And I would say maybe a total return of, let's say, 15%, and then the net to the investor, 8, 10, 12%. I think that's the best I can do for the limited time we have right now. It's very much more detailed than that. And of course, you're adding appreciation on top of that, which could perhaps be 5 to 15% a year. Principal pay down, which would be 2 to 4% a year after the interest only period. So we are getting close to wrapping it up here. It's getting into the 50-minute range. So if you like this presentation, please give BiggerPockets a thumbs up, a like. Please share this, put on the hearts or whatever. I will take one or two more quick questions. Glenn Miller says 400 to 600 is a typical size facility with a mix of 5x5 to 10 by 30 storage units. That's right. Self-Storage Association says that 2-story facilities is like found money. Yeah, that's true. Now, don't forget, you're going to have additional maintenance and capital costs by putting in an elevator to the 2-story facilities. But I agree. Unless you do the kind that's a drive-in, like the front is on this level and then the basement is like a walk-out basement in a house. And there are some like that. There's not many. But that is a great way to go, and it actually saves on construction, and you don't need an elevator. Nilofer Khan says, could be seller financing or still some down payment required. There are lots of people who do zero money down. Brandon Turner writes about zero money down deals, and they're still available. So $400,000 down payment. Yeah. So Nilofer, yeah, down payment could be about $400,000. And like I said, you can sometimes you can finance that. So I'm looking over here at Facebook and seeing 67 comments and realizing there is no way I have answered all those. So hopefully I got to a lot of the questions. And I really appreciate this opportunity to get on here on BiggerPockets. I want to thank Zach, Gwynn, and BiggerPockets. I want to thank all of you. There's probably a couple hundred of you in total on the 3 different venues, and then a couple thousand who will watch this recording. So thank you very much. I'm Paul Moore. I'm with Wellings Capital, and it'd be great if you would reach out to me on Wellings Capital if you on BiggerPockets if you have more questions, or you can contact me at Wellings Capital as well. We're going to be doing another presentation soon, so watch out for that. There's going to be several more live presentations this week you won't want to miss. And if you have not got the BiggerPockets Pro membership yet, I don't make any money from this. I'm just telling you, it is the best, one of the best investments, if not the best, I've ever made in 25 years of being an entrepreneur. So the BiggerPockets Pro, it's BP1234. So use the discount code capital B, capital P, 1234 to sign up and get a discount on your BiggerPockets membership. Thanks so much, everybody. It's been great chatting with you, and we will see you on the next BiggerPockets live event. Thanks.